Hi, everyone. Thanks for joining us today. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box. The panelists will answer those queries during or after the webinar as appropriate today. And if you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to today's panelists. And I'll get the right slide up. Here we go. Here's our panelists today. Christopher Hunter is a certified financial advisor with Merrill Lynch Wealth Management. Chris works closely with individuals, couples, and families, helping them organize, grow, and transfer their wealth more effectively. Chris helps clients move from where they are to where they want to be based on their distinctive goals and life priorities. Chris is based out of the Metro Jacksonville, Florida area, but works with clients throughout the country. Noelle McDaniel is an attorney with Rogers Towers in Jacksonville, Florida. She practices principally in the areas of wills, trusts, the administration of estates and guardianships, and the taxation of estates, gifts, and generation skipping transfers. Most recently, Noelle has been recognized by the Best Lawyers in America in Trusts and Estates and Elder Law in 2021. She's also involved in the community as a member of several boards, including the Board of Trustees of the Jackson Police and Fire Pension Fund, the University of North Florida Planned Giving Advisory Board, and the Estate Planning Council of Northeast Florida. Daryl Clarkson is a licensed certified public accountant in the state of Florida and is with Pivot CPAs. Daryl has worked extensively with small to medium-sized businesses, and he believes in proactive tax planning. Daryl is focused on delivering personalized service and attention to his clients. And in the community, Daryl serves as a member of the Rotary Club of Ponte Vedra and as a member of the Economic Roundtable of Jacksonville. Well, I'm so excited to have our panelists here today. I'm going to turn the time over to Chris to get us started, and we're excited to talk to you about this topic. Okay, Chris, here you go.
Well, good afternoon. Before we get started, I'd like to take a moment to thank all of you for your service and bravery as our nation and the world has battled the COVID-19 virus over the past year and into the present. Your dedication to the health and wellness of our communities is heroic, and we thank you. I know that many of you are joining us today during your break or in between patient appointments, so I want to make sure that we're respectful of your time. Today's presentation will cover 5 basic areas all physicians should consider when it comes to investing, asset protection, and planning for their financial futures. This webinar is geared towards physicians who live in the state of Florida, primarily because our panel of specialists, Daryl and Noelle, are specialists in tax and law for the state of Florida. However, I know that there are some of you who may be joining us on today's call that live in other states, and that's okay. Many of the topics we'll be discussing will cross borders and may apply to the state in which you live. In the event that's not the case, again, it's okay. There's never been a situation we haven't been able to work through. Next slide. So the first step is setting up your accounts properly. And Florida is among the minority of states that recognize a special form of co-ownership between spouses called tenants by the entireties. And property held in tenants by the entireties has automatic rights of survivorship. That is, it avoids probate. It is not unilaterally divisible by one spouse. It is exempt from the individual creditors of either spouse, but not exempt from joint creditors. One thing to know is that any creditor protection associated with property held as tenants by the entireties terminates upon divorce or the death of a co-tenant spouse. One example, if someone sues one spouse and wins a court judgment, in most states, the creditor can't seize and sell tenancy by the entirety property to pay off the debt. And if one spouse files for bankruptcy, creditors generally can't reach or sever property held in tenants by the entirety. Again, this is a basic asset protection technique that all physicians and their spouse should take in the state of Florida to protect their property. It's easy to set up and works just like any joint bank account or investment account you'd otherwise set up with your spouse as joint tenants with the rights of survivorship. Next slide. So let's talk about your most valuable asset. You've put in the time, the hard work, the late nights, and endured the stresses that come along with becoming a physician. And I'm sure that it comes at no surprise when I say that you are your most valuable asset. Your ability to work and earn an income to support and provide for your families is important, and it needs to be protected. Disability insurance is a great way to protect your income. As a physician, it is critical that you choose a definition of disability that covers you and your medical specialty. This means if you become too sick or injured to work in your medical specialty, you can still work in another specialty or occupation and continue to receive benefits. When you purchase a policy, each company classifies your medical specialty into an occupational class to determine rates. The higher risk specialties such as surgery, anesthesiology, and emergency medicine are in a separate, typically more expensive class than those less risky specialties such as internal medicine or general pediatrics. It is important to note that a policy is based on the occupational class at the time of application, but the claim will be based on your occupation at the time of the claim. So if you're currently in a less risky specialty, but are moving into a riskier specialty, for example, from internal medicine to cardiology, you may want to consider purchasing your policy prior to making that change to lock in the more favorable rates. Next slide. So life insurance. Most people understand the primary benefits of having life insurance. Your family gets money if you die unexpectedly, and you get the reassurance of knowing that you'll have resources to help them carry on without you. While those benefits are generally true for all kinds of life insurance, there are other important advantages depending on the specific type of policy and amount of coverage you get. All life insurance policies can give you financial confidence that your family will have financial stability in your absence. But in general, the more life insurance you have, the more benefits it will provide to you and your family when needed. So some applications of life insurance include income replacement for the years of lost salary, paying off your home mortgage, paying off other debts such as car loans, credit cards, and student loans. Perhaps it's funding your child's college education or helping with other obligations such as an aging parents. Or perhaps you want to leave a defined legacy to your children, grandchildren, or charitable organization. Most of these benefits are easily covered through term or whole life insurance. The difference between the two is simple. Term insurance is like renting. You might rent a $1 million term policy for 10 or 20 years or until your kids go to college. Once the term ends, the contract expires worthless. But if you had died unexpectedly during the term, the insurance company would have paid a $1 million tax-free benefit to your family or beneficiary. Whole life, on the other hand, is permanent and accrues cash value and will last your whole life. It is guaranteed to pay a benefit to your family or beneficiary when you die, as long as you pay the required premiums. Now, There are different types of insurances called variable universal life, which can have living benefits and death benefits, much like that of whole life insurance. Now, we often use these types of policies when working with our physicians who are considered highly compensated employees and have limited or no ability to fund their company 401k or 403b plans. Now, we design these policies to be tax advantaged. So what do I mean by that? That means that our physicians fund these policies with dollars that have already been taxed. These dollars then grow tax advantaged within the policy. At a later point, generally during retirement, we structure income tax-free distributions from the policy, and it works much like a Roth IRA. The distributions are not reduced by taxes and are income tax-free.
I did have a couple questions coming up, Chris. Someone asked, should I just use the insurance that I'm offered through my work, or is that something that I need to look elsewhere for?
So the insurance offered through your work is a great place to start, but sometimes is not sufficient to cover all the needs that one might have should they die unexpectedly.
All right, and then also someone said, well, this is maybe just let me reform this a little bit. So what emphasis should you put on disability versus life insurance? Which is more important as far as the allotment of how much you're going to spend in each?
So that's going to be different depending on your situation, but disability insurance is important because without disability insurance, if you don't die, you want to make sure that you can support your family. With life insurance, there are some riders that you can add to the policy that will help to pay premiums should you become disabled, but you really need to be able to protect your cash flow. And I would hold disability insurance a little higher on the totem pole than life insurance to start.
All right, I think we've answered that question. If we didn't, please just chat that in for us. All right, have we finished the information about life insurance?
Yep.
All right, let's move on.
Okay, so as I mentioned in the previous slide, universal life insurance is a great tool for highly compensated employees to grow funds tax advantaged. Now, SEP IRAs are probably one of the most popular tax advantaged vehicles that our self-employed physicians use. They are easy to set up, cost efficient, and straightforward. And typically, our physician or business owner will make discretionary employer contributions up to the lesser of $58,000 or 25% of employee compensation or 20% of net earnings from self-employment as determined under the SEP IRA rules. And this is an area that you want to receive advice and guidance from your accountant or tax professional. One thing to remember here is that if you do contribute, you must also contribute for all participants who are eligible for the plan. The benefit of the SEP IRA is earnings growth, tax deferred, and contributions are also tax deductible. Solo 401ks. Solo 401ks can be a great tool to use if you have other business interests, especially with a spouse. Several physicians I work with also have real estate holdings and investments they own with a spouse, usually under an LLC. If structured properly under the guidance of your accountant and tax professional, this could provide additional means to save money that is tax deferred, where contributions are also tax deductible. In fact, if set up properly, a married couple could potentially defer as much as $116,000 or $58,000 if you're single. Next slide. So these are just some basic planning documents that all physicians, really all people, should have. The first of which, the pour over last will and testament. This short version of a will and testament appoints a personal representative and simply authorizes that person to transfer any assets you may have held in your individual name at the time of death into the name of your revocable trust. The process of having a personal representative appointed to distribute your individually titled property is called probate, which is one thing that we want to avoid. Revocable trust. This document is used by Floridians as a substitute for a traditional will and testament. It'll control the disposition of your assets upon your incapacity or death. It does not have to be filed with the probate court, so it's kept private. Durable powers of attorney. This document allows your agent to transact business or perform other actions on your behalf that are specifically spelled out in the document. It is durable because it remains in effect even after your incapacity. However, it does terminate at your death. Healthcare surrogate. This form allows you to select a healthcare agent, which is sometimes called your surrogate or proxy, to make decisions regarding your non-life ending medical treatment in the event that you're unable to do it yourself. In other words, it only takes effect when you can no longer understand and communicate critical decisions, or when you don't want to make those decisions. A living will. A living will is a written declaration of your desires regarding the application or withdrawal of life-sustaining measures should you fall into an irreversible vegetative state and your doctor determines that there's no chance of recovery. Without this document, your attending physician is likely to use all methods possible to keep your body alive. Again, these are just some basic planning documents that all people should have, including physicians. Please also know that the complexity of these documents can vary based on your situation.
So we do have another question. Maybe Noel might be better to answer this. It seems like, of course, physicians don't always take care of themselves the way they want their patients to take care of themselves, but it seems where to start. This seems like a large project. Is this something that can be done quickly, or is it a long process? Can you maybe give kind of a where to start and how long that's going to take?
Sure. To create an estate plan, it would involve you contacting your attorney. You'd likely have an initial meeting, come up with a plan that fits your needs. And I know my process is from that point, it usually takes a few weeks at least to put together the drafts of the documents for the client. And then you come back in to sign the documents and finalize everything. I say all in all, it's probably a couple month long process, sometimes shorter, sometimes longer, depending on different factors, but it's manageable. The first step is finding the right attorney, the right estate planning attorney that practices in that specific area, and just getting the ball rolling.
Thank you. And then I did have a question for Daryl. I'm going to go back to the slide here about saving tax efficiently. I don't know if this applies to it, but when you're dealing with a married couple that has two separate, and let's say one owns a business and another one is a physician in a practice, should they have separate accountants, or can they use the same accountant? How do they go about parsing that out?
So would they, if they're asking specifically if they should share a CPA, I would say yes. Obviously, they're making decisions that would affect both of them. In regards to should they file jointly or separately, I think that is something that can be looked at individually, but jointly is going to be the better answer nine times out of 10, almost all the time. So I'm not sure if I'm answering their question. They're welcome to add on to that if they'd like.
All right, let's go ahead and move forward. I'm sure there'll be some more questions about this in the future.
So Revocable or living trust, it's a highly used tool that a lot of clients, not just physicians, use, but people use revocable trust, also called living trust, for two main purposes. The first is to provide a smooth transition of asset management in the event of their temporary or permanent incapacity. And two, after they die, to avoid court supervised probate in the administration of their estate. This can be cumbersome, time consuming, costly, and public, and using a revocable or living trust often avoids that. However, to achieve these two goals, people have to fund the revocable trusts during their lifetimes by retitling their assets into the name of their trust. So remember, it's your responsibility as the person, not necessarily your lawyers, to fund your revocable trust. Merely signing your trust document, which includes a schedule of your assets to be included in the trust, is generally insufficient to retitle those assets into the name of your trust. So you'll most likely need the help of your lawyer to transfer certain assets like real estate, large boats, and planes, while other assets such as bank accounts can be retitled by you. So assets that you might want to fund into your revocable trust include, real estate. Remember that spouses who hold real estate as tenants by the entireties should also understand that the limited creditor protection afforded to those assets can be lost when converting the title from tenants by the entireties to the name of the revocable trust. Bank accounts and investment accounts, and closely held business interests. Many closely held businesses are subject to buy-sell, shareholder, or partner agreements that restrict the transfer of ownership interest. So you should have your lawyer, review those documents, before retitling those ventures. Contracts, mortgages and notes, automobiles, boats and planes, tangible personal property. So it is possible for you to transfer personal property such as clothes, art, and jewelry into your revocable trust using a deed of gift. Now, it's important to remember that dealing with revocable or living trusts can be complex, and it's always best to get the advice and guidance of your attorney.
Chris, I'd like to just interject. I get a lot of questions about the revocable or living trusts in regards to taxes, and Noel can jump in as needed, but normally they continue to file on your personal tax return under your personal Social Security number. So it does not affect your tax, how you treat the accounts for taxes. Noel can jump in as needed on that, but I get that question a lot. I just thought it would be important to add.
And yes, Daryl, that is a great point. The tax identification number for the revocable trust is the creator Social Security number. So it doesn't create the need for any separate tax return to be filed. You're exactly right. That's a good point. Another point about the revocable living trust, and a question I get asked oftentimes, is if I place my assets in a revocable living trust, does that protect it from creditors? And the answer to that question is no. A revocable living trust does not put up a barrier against claims from creditors. It is simply a way of avoiding probate and keeping things running smoothly, both during your lifetime, if you're incapacitated, as Chris said, or upon your death and transitioning the assets to your heirs.
That was actually one of the questions that had come up. In what cases would you want or not want a revocable trust? Another follow-up question to that is, what assets does it make sense to keep out of the trust?
There are certain assets that we cannot put into a revocable living trust, and those would include qualified retirement plan accounts, so 401ks, 403bs, IRAs. Those have to be owned in your individual name. In Florida, there's some specific and unique laws that govern your homestead property, your primary residence. And for that reason, for some individuals, it does not make sense to put the house in the trust. But overall, most other assets, as Chris was touching upon, closely held business interests, brokerage accounts, non-retirement brokerage accounts, bank accounts, real estate that's not your primary residence real estate in Florida, it makes good sense to put all of those assets in the trust.
And here's another question about trusts. Do you have to have someone who manages the trust, or can you manage the trust yourself?
During your lifetime, you manage the trust yourself in terms of you maintain complete control over the trust and its assets. You're the sole beneficiary during your lifetime. Now you could still have a financial advisor who would manage the assets for you, just like you would now. But otherwise, you maintain complete control over your trust during your lifetime.
And then where does it go? Is it like a named beneficiary or a named person that is in charge of the trust when you pass?
Yes, the trust document, under the trust document, you'll designate a successor trustee, which would be the individual who would step into your shoes if you become incapacitated or upon your death, and they would take over managing the trust assets and distributing the assets in accordance with the terms of the trust to your beneficiaries.
Right, Chris, I think we're ready to go over this part now.
So this is essentially just a list of different assets that are exempt from creditors in the state of Florida. We went through a good number of these during earlier points in the presentation. Some things that were not listed or not spoken about would be, annuities, 529 plans, and spendthrift trusts. Those are some things that are more well known to people out there, but essentially this is a list of things that are exempt from creditors for the state of Florida specific. So I don't know if you want to leave that up there, if anybody wants to take a screenshot of it, but there you have it.
And then we will also host this webinar on our YouTube channel. So if you're looking for a replay, well, that will be on YouTube after it's gone through our video department. Okay, so we do have a couple more questions here. Let me get to the right slide that goes over these. Can you quickly review what are the limits for example, a SEP account?
Chris, I guess I can jump into that. So Chris mentioned approximately a SEP IRA is approximately 58,000, I'll say, for the 2021 tax year. That is based on a percentage of your business income or wages through a small business. And then there is some additional increase based on your age if you're over the age of 50. That's in regards to the solo 401k or the 401k. It's going to work very similar to there's an employer portion and employee portion, and they will also max out at that same number. And just additionally, what I see in a lot of solo practitioner, a lot of solo physicians is there's the ability to add on to the 401k that a lot of people really like, and that is a profit sharing plan and a cash balance or defined benefit plan that really allow them to increase those the amount they can contribute to those retirement accounts.
Great. I'm going to pull up another one here. Can you talk a little more about disability insurance, Chris, as far as how to know if you're getting the right amount, and if there's a different types of disability insurance like there is with life insurance?
Yeah, so the amount of disability insurance that you're going to qualify for is going to depend on what your current income level is, so to speak. There are ways to build in future adjustments and the potential benefit that could be paid out over time to at least index with inflation. With physicians, it's just important that you choose the appropriate definition of disability. For example, if you were to choose any occupation and you were a surgeon and you went skiing and hurt your hand and had nerve damage, Any occupation would mean, well, Mr. Jones also has the ability to, go work at McDonald's or do administrative work. And so they may or may not pay out that claim. So getting the appropriate definition of disability, especially in your line of work, is critical.
All right, thank you. And I think, let's see if I have any more questions here. I think we're okay. If you have more questions to my audience, we're going to wrap things up here, but you're welcome to leave them in the chat, and we will reach out to you if we can help you. We would be happy to do that. So once again, on behalf of Advice Chaser, I want to thank our panelists and the organizations that have worked with us to bring you this webinar today. Thank you so much for attending, and look for an email soon with a link to the replay of this event. And you're welcome to share that replay with your friends or family. And as I mentioned, we will be hosting this on our YouTube channel as well. Here at Advice Chaser, we're all about helping you find a financial advisor who is a great fit for you, your life, and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone they introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. And once again, from Advice Chaser, thank you so much for coming. We'll see you at another webinar soon. Goodbye. Thanks to our panelists.